The market was silent. But decades before charts, numbers, and billion-dollar trades, a young boy was learning lessons that no textbook could ever teach. George Soros was born into a world that was already beginning to crack under pressure. Europe in the 1930s was a place filled with uncertainty, political tension, and rising fear. As a child in Budapest, he witnessed something far more powerful than money. He witnessed human behavior under extreme stress. War changes people. It forces them to make decisions quickly, often without knowing the outcome. For Soros, survival became a daily exercise in understanding risk. He watched adults make choices that determined life or death, and these experiences quietly shaped the way he would later see financial markets. While other children worried about school or games, Soros learned to observe. He noticed how fear spread through crowds and how rumors changed decisions. Even as a young boy, he began to understand that people rarely act purely on logic. They react emotionally, often creating chaos. Years later, when traders tried to explain his success, many focused on charts and strategies, but the truth was deeper. The roots of his thinking were planted long before he ever entered a trading floor. They came from watching society move like a living organism, unpredictable, emotional, and fragile. After the war ended, the world was rebuilding, but Soros felt restless. He carried memories that would never fully disappear. These memories created a mindset that embraced uncertainty rather than fearing it. He learned that stability could vanish overnight, and that understanding change was more important than resisting it. This early chapter of his life was not about finance. It was about psychology. It was about learning how people behave when they feel pressure. And unknowingly, the young boy who once navigated a dangerous world was preparing himself for the unpredictable battlefield of global markets. As Europe began to recover, Soros realized that staying in one place might limit his future. He dreamed of something bigger, a new start in a new country. And so, with little more than determination, he set his eyes on London, a city that would challenge him in ways he could never imagine. The journey was just beginning, and the market, though still far away, was waiting for him.
London in the late 1940s was not the glamorous financial capital many imagine today. It was a city still recovering from war, filled with rebuilding projects and people trying to find stability again. When George Soros arrived, he was not a future billionaire. He was simply another young immigrant trying to survive. Life was difficult, money was scarce, and work was hard to find. Soros took small jobs just to pay for his education. He enrolled at the London School of Economics, where he studied philosophy, a decision that seemed unrelated to finance at the time, but would later define his approach to trading. Philosophy taught him to question reality itself. He became fascinated with the idea that human perception could shape outcomes. This concept stayed with him long after he left the classroom. While many traders focused on numbers, Soros began thinking about how beliefs and expectations influence markets. He often felt like an outsider. London was unfamiliar, and success did not come quickly. Rejections were common, and he struggled to break into the financial industry. But each setback strengthened his resilience. During long nights of study and work, he started forming ideas about how systems behave. He wondered whether markets were truly efficient or whether they were driven by collective emotion. These thoughts became the foundation of a theory that would later guide his biggest trades. Eventually, he found an entry point into finance. It was not glamorous, just a small position that allowed him to observe how traders operated. But for Soros, it was enough. He watched carefully, absorbing everything around him. The markets felt alive. Prices moved not only because of facts, but because of fear, hope, and speculation. Soros realized that understanding human psychology might be more powerful than any technical strategy. London became his training ground. It was here that he learned patience, discipline, and the importance of long-term thinking. Every failure felt like a lesson, every challenge like preparation for something bigger. Slowly, he began to see his future more clearly. He was no longer just surviving, he was evolving. And as his confidence grew, he knew that the next step would take him across the ocean to the financial heart of the world. New York was calling. New York City in the 1950s and 1960s was electric. The energy of Wall Street was unlike anything Soros had experienced before. Traders moved quickly, decisions were made in seconds, and the stakes were enormous. At first, Soros felt overwhelmed. The pace was intense, and competition was fierce. But he also felt something else: excitement. For the first time, he was surrounded by people who lived and breathed markets. He started in modest roles, analyzing stocks and assisting senior traders. It was not glamorous work, but it allowed him to observe how decisions were made under pressure. He noticed that even experienced professionals often acted emotionally, chasing trends or reacting to fear. Soros began experimenting with his own ideas. He made small trades, learning from both wins and losses. Some of his early decisions failed, forcing him to question himself. But instead of giving up, he treated each mistake as feedback. He realized that markets were not just economic systems, they were reflections of collective psychology. Prices moved because people believed they would move. Expectations created reality. This insight changed everything. Rather than trying to predict markets perfectly, Soros focused on understanding when perceptions were out of balance with reality. When he sensed that crowds were becoming too confident or too fearful, he saw opportunity. Colleagues noticed his unique thinking style. While others relied heavily on data, Soros often spoke about sentiment and human behavior. Some found his ideas strange, but results slowly began to speak for themselves. As his reputation grew, he gained more freedom to manage larger positions. Risk became a central part of his strategy. He was not reckless, but he was willing to make bold moves when he believed strongly in an idea. These years were crucial. They transformed him from a student of philosophy into a student of markets. And as he refined his methods, he began dreaming of something bigger, a fund where he could fully control his strategy. The stage was being set for the creation of a financial empire. Soros did not see markets the way most traders did. While others believed prices reflected objective reality, he believed that perception itself could change reality. This idea became the foundation of what he later described as reflexivity, the concept that market participants influence the very outcomes they are trying to predict. He noticed that when investors became optimistic, they drove prices higher, which created even more optimism. The cycle fed itself, sometimes pushing markets far away from their true value. The opposite happened during panic, when fear caused prices to collapse faster than logic would suggest. This philosophy was not just theory, it became a practical tool for decision-making. Soros began searching for moments when markets were emotionally stretched, times when narratives were stronger than facts. His approach required confidence. It meant sometimes going against the crowd, which could feel uncomfortable. But Soros believed that true opportunities often appeared when most people felt certain about the wrong idea. Risk management also became central to his strategy. He was known for quickly cutting positions when he felt he was wrong. Instead of protecting his ego, he protected his capital. Many traders struggle because they fear being wrong. Soros embraced it. He believed mistakes were part of the process, and that flexibility was more valuable than stubbornness. As his philosophy matured, his performance improved. Investors started noticing. Opportunities grew larger, and so did expectations. But with growth came pressure. Managing money meant managing trust. Soros knew that to fully express his ideas, he needed his own platform. And so he prepared to launch a fund that would change the financial world forever. The creation of the Quantum Fund marked a turning point. It was more than just a business venture. It was the realization of Soros's vision. For the first time, he had the freedom to apply his philosophy on a large scale. The early days were filled with uncertainty. Managing a fund required balancing bold decisions with responsibility toward investors. Every trade carried weight, and every result shaped his reputation. Soros approached the market like a strategist rather than a gambler. He searched for big themes, economic trends that could influence entire currencies or industries. This macro perspective allowed him to think beyond individual stocks. The fund began generating impressive returns. Success attracted attention, and attention attracted more capital. As assets grew, so did the scale of his trades. But growth also brought stress. Large positions meant larger risks, and Soros often described feeling physical discomfort when he sensed something was wrong in the market. Instead of ignoring these signals, he treated them as warnings. His ability to adapt quickly became legendary. When conditions changed, he changed. This flexibility allowed the quantum fund to survive periods that destroyed less agile investors. By the late 1980s, Soros had become one of the most respected and feared figures in finance. Governments watched his moves closely, knowing that his positions could influence entire economies. Yet the trade that would define his legacy had not happened yet. Somewhere in Europe, economic tensions were building. Currency systems were under pressure, and Soros was watching carefully. The opportunity of a lifetime was approaching. To understand George Soros, one must understand how he viewed the crowd. He believed markets were emotional mirrors reflecting human hopes and fears. Numbers on a screen were simply expressions of collective belief. He often described feeling the market's mood. When optimism became too strong, he prepared for reversal. When panic spread, he searched for hidden opportunity. This psychological awareness gave him an edge that statistics alone could not provide. Soros spent hours studying global news, not just for facts, but for sentiment. He paid attention to how people talked about markets, the tone of headlines, the confidence of analysts, the narratives shaping public opinion. For him, trading was not about predicting the future perfectly. It was about recognizing when the present story no longer matched reality. When he sensed a gap between perception and truth, he acted. This mindset required emotional discipline. Markets can punish those who hesitate, but they can also destroy those who act without reflection. Soros learned to balance intuition with analysis. As Europe moved toward deeper economic integration, currency relationships became more complex. Governments attempted to maintain stability through agreements that many traders believed were fragile. Soros began studying these systems closely. He noticed signs of strain, economic differences between countries that made fixed currency levels difficult to maintain. While most investors accepted official assurances, Soros questioned them. He believed that when a system depends too heavily on confidence, it becomes vulnerable to doubt. The stage was quietly being set for one of the most dramatic moments in financial history. In the early 1990s, Europe was attempting to maintain stability through a currency mechanism designed to keep exchange rates within certain limits. On the surface, the system appeared strong, but beneath it, economic pressures were growing. Britain faced challenges that made maintaining its currency level increasingly difficult. Interest rates, inflation, and economic conditions were not aligned with the system's requirements. Soros and his team began analyzing the situation. They saw a mismatch between policy and reality, a classic example of reflexivity. Governments wanted stability, but markets were starting to doubt whether it could last. Building a large position against a major currency was not a simple decision. The risks were enormous. If Soros was wrong, losses could be catastrophic. But if he was right, the rewards could be historic. The tension grew day by day. Rumors circulated, traders speculated, and governments issued reassuring statements. Yet Soros felt that the system was reaching its breaking point. He increased his position, betting that the British pound would eventually fall. It was a bold move, one that required immense confidence and preparation. As September 1992 approached, the financial world held its breath. The market was waiting for a signal, a moment when belief would finally shift. And then, the day arrived.
September 16, 1992. The atmosphere in financial markets was tense. Traders around the world watched the British pound as pressure mounted. The Bank of England attempted to defend the currency, raising interest rates and buying pounds to maintain stability. For a moment, it seemed as though the system might survive. But Soros had already positioned himself. His fund held massive short positions, betting that the pound would fall despite government efforts. As the day unfolded, confidence began to crack. Markets moved rapidly, and the cost of defending the currency became overwhelming. Eventually, Britain withdrew from the exchange rate mechanism, allowing the pound to drop. The move shocked the world. Soros's fund reportedly made more than $1 billion in profit. Headlines called him the man who broke the Bank of England. For Soros, it was not just about money. It was proof that markets driven by perception could overpower even powerful institutions. Yet victory came with controversy. Some praised him as a visionary trader. Others accused him of profiting from economic instability. The debate would follow him for the rest of his life. Black Wednesday became a defining moment, not only for Soros, but for modern finance itself.
After 1992, Soros's reputation grew beyond the trading world. Media attention intensified, and political discussions began to surround his actions. Some viewed him as a symbol of free markets. Others saw him as evidence of financial power gone too far. Criticism became a constant presence. Governments questioned whether large investors should hold such influence over currencies. Supporters argued that he simply recognized economic realities before others did. Soros himself often spoke about fallibility, the idea that no one, including him, could be right all the time. He acknowledged mistakes and emphasized the importance of adapting quickly. His success also allowed him to expand into philanthropy and global initiatives, further shaping his public image. But regardless of opinion, one thing was undeniable. He had changed how people thought about markets. The controversy highlighted a deeper question about finance. Are traders responsible for the outcomes of their strategies? Or are they simply participants in a system driven by supply and demand? As debates continued, Soros remained focused on understanding markets. He knew that fame could distract from discipline. And despite his achievements, he continued to treat trading as a learning process. Today, George Soros's legacy extends far beyond a single trade. His journey offers lessons not only about money, but about mindset. He showed that markets are not purely mathematical systems. They are human systems, shaped by belief, fear, and hope. Understanding psychology can be just as important as understanding charts. One of his most powerful lessons is the willingness to admit when you are wrong. Many traders fail because they protect their ego instead of their capital. Soros built his success by staying flexible. Risk management remains another key takeaway. His boldest trades were supported by deep research and careful planning. He did not rely on luck. He relied on preparation. For beginner traders, his story is both inspiring and cautionary. Success requires patience, discipline, and the courage to think independently. But it also requires humility, the understanding that markets can surprise anyone. As the documentary comes to an end, the image of Soros shifts from myth to human, a survivor of history, a student of philosophy, and a trader who believed that understanding people was the key to understanding markets. The charts may change, currencies may rise and fall, but the deeper lesson remains the same. The market is not just numbers. It is a story, and George Soros became one of its most unforgettable storytellers.